All right, taking a look at the stochastic divergence on the 10-year note. Looking at the daily chart, and what you see here is a market in the 10-year note that's making higher highs. Right here, you've got an acceleration. You got a range up bar here, and then a nice trend up, and new highs today here in the 10-year note. What you have in the stochastics here is you have a high uh, that's associated with this high, and then another high associated with this stochastic high. But this high here is higher than that high, but it's lower than this low on the stochastic, so it's going down. And in general, you see the trend down in the stochastics. But when the market got to this point, the stochastics started going up again. But still, this high is not as high as this high over here. So it's hard to draw this straight line on here. I'm not an artist or anything, but overall the trend in the stochastics is down in the midst of a very strong 10-year note and bonds rising. This is an inverse market, so as the stock market goes down, the bonds usually go up. And so what we've seen here is a Monday, and I want to take you to a stock chart so I can show you what I'm talking about. Create a matrix here. Look at the mini Dow and show you how it's done. So you see the stock market's gone down, and what a lot of times the markets will do is if there's been a lot of selling in the market on a Monday, the market will go down, continue on Monday, and then if there's a rebound in the market, it'll happen on Tuesday. And so we've talked about how we're bullish this market and how we don't believe there's going to be a lot of selling in May and going away. And so far this month, that's actually been the case. So there's been some selling in May. The market took out in the mini Dow, taken out these levels. If we take a look at the E-mini S&P, we told you that we were bullish until the market broke 1330, and it hasn't broken 1330 yet. It came close today, and we're still bullish this market. It came down here to 1333.25, and so we're still bullish up to this level 1330 the 1325 area, and seeing how it responds in there. So we're still bullish. The market has been selling off. There's been multiple gap downs. You see gap down here, gap down. There's 1 day, 2 days, 3 days, 4 days, gap up, 5 days, 6 days. So 6 out of the last 7 days the market is gapped down. But in general, there's not a lot of selling. The market goes down this much, this many gap downs, and it's only down 66 points in the E-mini S&P. It's not a lot compared to what we've made this year. And so starting out this year, we're here. And if you take a Fibonacci retracement, say to this point here at the end of December to this, you're still at the 38% level. You're coming into a 38% Fibonacci retracement at the point where we're bullish up until that point in the way we trade. And so bonds, the reason I show you this is because bonds are the opposite. So we see this move down, and then bonds have been making new highs. Bonds is in 10-year notes. And we're continuing our theme with the stochastic divergences. And so if you want to get long, one of the things you can do is you can get long the stock indexes, or you can get short the bonds. And so we're taking a look at a short trade on the 10-year note here based on stochastic divergences on a daily chart, but they're also on an intraday chart. So if you look at the 5-minute chart, we've got a short trade going here at 133.17 with a stop at the highs 133.20. Very low risk trade. It can easily get stopped out and then the market reversed, but this is the kind of trade that we're taking with the stochastic divergences. We're looking for a reversal in this market. You see this stochastic divergence intraday. The market you see a stochastic high right here, and the market is at this point, the market makes another high, but the stochastics come down. And so we didn't take this trade, but in the after hours, based on stochastic divergences, here, you see the market moving higher and another stochastic divergence. There's one intraday, and it's all over the daily chart as far as the 10-year note. So we're just going to take a shot at taking calling a small top, a risk in $100 on this trade, $93.75 plus any slippage and commission. So You can see the high is 133.19. We have our stop at 133.20, and that is our perspective on the market and our discretionary trading with stochastic divergence and how that can work in other markets and on daily charts. Quick look today at the E-mini Dow intraday. You see a signal here. I'm working on a stochastic divergence signal. I don't have it completely finished yet, but what you've got here is you've got a low on the stochastics as the market goes down and it makes another low, but the stochastics move up, and then a long entry signal here. Last week we talked about how we like to take these trades after 10:30 or somewhere between 10:30 and 11:30 is when we want to start taking these trades. But this one happened a little early today. I didn't take it. It would have been a great signal had you held it to the end of the day. You still would have been profitable. You could have traded for a profit target or to take out new highs or a trailing stop loss and done better than an end of day signal, but it's still profitable. You see that was the only real 1, 2, 3 bottom below the 20% line that acts as a stochastic divergence, and there was no other signals here today, just this one that happened here at around 10:15, 45 minutes into trading. A lot of times those 15-minute intervals are the times that the market will reverse, and it did so today on a stochastic reversal. So it called a nice signal today. It didn't take it, but we're looking at taking this trade in the overnight session, shorting the 10-year notes on a very tight stop, and seeing how this plays out. If it can reverse and take out the 133 level or the lowest low of the last 3 bars, 132.17. Nice risk to reward ratio. One thing you have to realize when you have tight stops is that you can be wrong more often than you can be right. So you might be stopped out more than half the time, but your winners can make up for it if you get some big moves and you have a good strategy. So this is the discretionary approach that we're using with stochastic divergences that we've been talking about and following up on this week.